Hello, everyone. This is our 473rd video. I'm just kidding. I don't know how many videos we put out now. So I have been trying to figure out how to explain this debt thing in capital structure and financing because I still feel like we're kind of butting up against the idea of, well, if we pay off all this debt, life's going to be good and we're doing okay. So kind of interesting of a few of the student submissions. Try to get this set a little better. Of the student submissions um, that I've had so far, it oddly, the three students have looked at Target, Costco, and Walmart. And as I was going through, and I hadn't, the last one I looked at was Costco. And I looked at their capital structure and their debt ratio. I and I don't look at debt ratios. My mind is wired to capital structure. So if you imagine a pie chart, so a pie chart of 50-50 tells you 50% debt, 50% equity. That's just kind of how I look at it. But what we're trying to understand is, well, why? Why would you, if you're trying to run a business, what sense does it make to borrow all this money? And again, we're trying to understand this has to do with knowledge, know-how, and employing your capital resources to maximize your position. Because what ends up happening again is human beings have a tendency to we want to we want to try to apply a heuristic. A heuristic is a rule of thumb. It's, well, if I wouldn't do it in my household, then we shouldn't do it in our hometown. Okay. And unfortunately, I think with debt, especially in a corporate finance setting, we have that tendency to believe that, well, we need to pay down this debt. And you have to ask the question, then why aren't these companies doing that? And in these retail companies, I thought it was quite interesting. Two of them look like we're a capital structure of 50-50, and one of them we have at 25. Now, I understand trying to understand a financial analysis of a company that has $300 billion in revenue. It's like, how do you begin to understand that when most of us struggle understanding complex things, me included? Um, I get it, it's challenging, but I caught something as I was reviewing Target, Walmart, and Costco. And this is just one sort of thing to look at, but I thought it does a good job of trying to help to understand. And I'm going to use Yahoo Finance, and you talk to most people that work in the realm of finance, and they say if you're not using Morningstar or one or two others, that you're not reusing real data, real information. I understand that, but I again just want to get to a point here of trying to understand this idea of capital structure and strategy. So when I had just looked at an analysis of Costco, I noticed that their debt to equity ratio was like 25 in fourth quarter 2024, whereas Walmart's was 0.54 and Target's was 0.47. So just to try to get a basic understanding, Walmart and Target look like they're using, give or take, roughly about 50% of their financing through debt. Then you have Costco, who is at 0.225%, so only about 25% debt. And there's some benefits. So I'm sure there's some analyst out there that's going to watch my explanation and cringe, and that's okay. I'm still going to kind of go through this just again to help folks understand a little bit better in this capstone strategic management class. All right, let's share here. So, real quick, I looked up on AI in Costco's capital structure. It relies on debt far less than the other two of Walmart and Target. Um, Why would you want to do that type of approach? And it talks about trying to minimize financial risk. One of the benefits to having lower debt is you don't have debt payments. Okay. Your interest that you're paying on this is lower. Now, the problem we have with this, again, is we're simplifying this way too much, and we're operating under the assumption that uh, if you're using debt, that, well, you have to make those payments, and at a minimum, you have to pay the interest payment on that debt. That's required. You don't get to not pay that. When you look at equity, though, okay, stockholders, too often we kind of think like, well, we don't really have to pay them. Um, into some level, that's true. You might pay them in a dividend, but if we're talking about earnings, okay, and we compare our return on equity, so the earnings on our invested capital, when it's stock, common stock, you're not paying anything out. The way the stockholder benefits in that regard, very often, if not a dividend, in not preferred stock is capital appreciation. Okay. That's how they get paid. So when I go buy Costco stock, well, let me look here real quick. Nope, not that one. There we go. If I were to go look at buying Costco stock today and it would cost me one share would be about $973. Okay. Uh, Remind me to go back to analysis, even though there's nobody here to tell me that. If we look at, I wonder if they don't have it on here. I'm trying to look at their if they pay a dividend. Well, imagine they do pay a dividend. Typically, a dividend of a retail company, a stock like this, would be somewhere between 2 and 4%. So if I pull up a calculator and we have, let's just say 975,000, and we multiply that times 0.02, which is 2%, on my $1,000 investment, I would get like a $20 check. Now, I don't, unless you are an institutional investor, okay? So you're investing billions and billions and billions of dollars. That dividend doesn't mean much of anything. And in fact, if you are an institutional investor and you're investing into Costco and it is billions of dollars, if you were to get asked, would you rather have that dividend check, which an institutional investor might want because maybe they're using that money to pay for their expenses. Okay, they might want that, but you're not talking oodles and oodles of money here. Okay. And most often, investors, if given the option, would rather the company reinvest that dividend money back into the operation of the company to grow it. So when you're trying to understand how companies operate, we kind of miss that because again, we boil it down to like a lemonade stand, and Costco is not a lemonade stand. The complexity of what it's trying to do is very, very tough for most of us to understand. So if the preference for almost all investors, especially in 2025, is, hey, take that money, Costco, go buy another store, go expand it, go do that. Why? Because even as an institutional investor, if I get a dividend check from you, what am I going to do with it? I either will use it for my expenses, my day-to-day expenses, just like I would if I got a $20 check in the mail. I don't know. I'd maybe go to McDonald's or go to a, Jimmy John's or something and buy a sandwich. I'm not really going to do anything with that. So my preference would be Costco takes that money and reinvests it so it can go get more earnings and the stock price can grow and grow and grow exponentially. What we're trying to, or what we want to see is them employing that kind of capital to maximize their position. That's what our preference is. That's in most institutional investors anymore. That's their preference. Okay. So you have debt and you have equity. When you have debt, a little bit like paying a dividend, you have an expense that is going out, a cost to doing this. Plus, however they structure it, they have to pay back that debt as well. Okay. So you have money going out. And the question is, if they don't have that money going out in debt, We assume, well, then they're more flexible. They can maneuver a little bit better. And that's true. But what instead if Costco and Walmart or Target, all of who hire very experienced business analysts, decision makers, people that they've been working in this industry probably for 25 or 30 years, and very often at a pretty high level to understand how do you manage all this. Their job is to maximize their position. That's what they're supposed to be using this money for. So when you employ and you utilize both debt and equity, then you can maximize your position at a much greater rate or much greater level than you could otherwise. Now, there's a trade-off when you do that. Okay. A portion of that has to get paid back. You must do this. So when we look at business risk and financial risk, it all boils down to what do you know how to do? What can what do you know how to do really well? Or one of you know how to do really well that the other two don't know how to do well. And how do we maximize that? Okay. So when we look at these capital structures, we look at debt ratios, and we're looking at both Costco, we go to analyst. Costco, whose quick ratio is at 0.25, so about 25% is debt financing. And then you look over at Walmart and Target, and theirs is closer to 50%. I was looking at analyst estimates to figure out, well, okay, if you're an analyst, you're looking at every data point here, every metric here that you can get your hands on. So the question is, well, which ones would you recommend buying more than the other? Because if you're an investor, and whether you're a retail investor or an institutional investor, you're usually trying to invest that money into a sector or an area that you, in fact, are knowledgeable in or have become knowledgeable in. Okay. So if I have $10 billion, let's boil this down to something more understandable. Let's say I am South Dakota's pension fund system who's going out and investing money. If I'm going and trying to look at in an asset allocation, where do I want to invest this money? I might say, well, how about the retail sector? How about we look at Walmart, Target, and Costco? Then when I look at all of those, which ones, which one do I want to pick? I want to pick the one that stock is going to go up at the greatest rate or the most or appreciate or have the highest dividend, whatever. But I want that to be maximized. So when we look at Target, we look at Walmart, we look at Costco, the question isn't, well, how are we doing today? It's how are we forecasting into the future? What do we think we can do? How much do we hope to grow and by what amount? So when I was looking at Target's analyst recommendations, and this is the makeup of those, Target has, I don't want to try to do the math here because I would need that expanded. No, it doesn't expand it. You have here of a buy of estimates 11, 7, and 7. Your analyst saying hold this stock, don't sell it, is 23, 25, and 25. Okay, that's target. So you have a few that are saying buy. Um, Now we can, I don't want to convolute this because you can use any number to mean anything you want. That's why I'm boiling it down to this one. Okay. Then we go over to Walmart and we look here and we say, oh wow, they're they got a lot more. They're a lot higher strong buyer recommendations to buy. Have a much stronger hold. Okay. Now let's go look at Costco. If I can click on Costco, it should be that one. Hold on. There we go. Okay. If we have Costco, you'll notice here, well, they too are they've got some buy, uh, in a few strong buy, but kind of closer to 50-50. Hold it, maybe buy. Walmart, much higher. Hold it and buy. Target, similar to Costco. Okay. Maybe less similar. So when we look at their capital structures, though, and we look down on this, you'll notice, well, Costco has the lowest level of debt to its overall capital structure. Walmart has the highest, and Target has slightly less than Walmart. So what's going on there? Okay. And it's not about the issue of thinking about debt like in a household. It's the issue of which one of these is employing all of its resources to maximize its position. So if what the how you structure that gives you either flexibility or not flexibility. The question comes down to, do you know how to do this and do you know how to do it well? Now, many would argue, I think all of them know how to do it pretty well because they all seem to be still growing, um, and pretty much killing every small business on the planet, but whatever. They're still growing. This one though suggests that, well, Walmart's the one you may want to get your hands on. Okay? Because that's the one that's employing their capital to maximize their positions probably in the best way. Now, again, there's 1,000 metrics that you can try to manipulate and use to your advantage in any capacity. I'm just using one because I mentally was trying to, how do you boil this down to explain this to a class of 29 students quickly? The other, so when Costco, Target, and Walmart are competing, they're, believe it or not, they're not just competing against each other. They're not just competing against the other two, plus Lewis and Waldrug or Walgreens, not Waldrug, Walgreens and all these other ones, they're competing through all these things. But the other thing they're competing is for investors and people to give them money so they can better maximize their position. Okay, I think I'm going to just leave it at that. But I wanted to show you that, well, my point was when we looked at the investors giving recommendations to buy or hold. In this capacity, if we were looking, well, how much debt do they have? Well, Costco would be the surefire winner. And we were using it as, well, who's got the least amount of debt? Well, but that's not who analysts, okay, the big major investment banks and companies that do this, they're giving the strongest recommendation to Walmart, who happens to have the highest amount of debt relative to their equity. So that was kind of my point is that looks like the better buy. But if you use debt alone as a metric, in thinking, well, they should pay it down. No, they shouldn't. They should use as much as they can to employ it in the best way it can in order to be as competitive as it can be to beat the other guy and to try to find and sustain that competitive advantage. All right, I'm going to leave it at that. I again just thought it was odd that I had the first parts of the project with those three students all doing Target, Walmart, and Costco. We will check you later if I can figure out how to stop this.